distinguished guests, officials from Knight Frank Kenya, esteemed clients, members of the board, the executive committee, management and staff of Victoria Commercial Bank, good morning. My name is Javed Khanna and I welcome you to yet another enlightening and informative webinar on the property market performance before and during COVID-19, hosted in collaboration with Knight Frank Kenya. I will quickly take you through the program schedule. So taking us through the topic will be the Knight Frank Kenya's Managing Director, Mr. Ben Woodhams. Following his presentation, there will be a panel discussion with Mr. Woodhams and the Knight Frank team. We will then have a brief question and answer session before the concluding remarks. As attendees, your mics will be turned off, and so will be your cameras, but we will be encouraging you to type in whatever questions that you may have in the chat box so the presenters can address them after the panel discussion. We aim to end the webinar in about an hour. So I would now like to invite a distinguished personality from Victoria Commercial Bank. He has over 29 years of expertise in the banking and finance sector. He is the overall key business driver of the bank, a critical thinker and a mentor. Ladies and gentlemen, let's welcome our Business Development Director, Mr. Manish Parmar, to address us.
Thank you, Javed. Distinguished officials from Knight Frank Kenya, our collaborators for today's webinar, esteemed clients, Victoria Commercial Bank board members, management and staff, good morning. I take this opportunity to welcome you to today's webinar, a relevant discussion on the topic property market performance before and during COVID-19. Like other markets, the real estate sector was significantly affected by the pandemic last year. The residential, commercial, as well as retail segments witnessed a general decline. However, as the world recovers from the fear of the pandemic and with the global reports predicting a rise in the real estate industry, backed by support from the financial sector, what does this mean for Kenya? We continue to brace uncertainty over COVID-19 and have an impending election ahead. Therefore, the question begs, what is in store for the property market in Kenya? Many of us are keen to explore the property landscape and make informed investment decisions. Hence, we at Victoria Commercial Bank felt time was right to learn more about the property market's performance before and during the pandemic. To address us on this topic, we have Mr. Ben Woodhams, who is the Managing Director of Knight Frank Kenya, the leading independent property consultants in Kenya, headquartered in Mombasa. They advise clients ranging from individual owners, buyers, to major developers, investors, and corporate tenants. They are part of Knight Frank Global, which is headquartered in London and has more than 20,000 people operating from 488 offices across 57 territories and 8 African countries. Ben Woodhams has over 20 years experience in the real estate consultancy. As Managing Director, he is responsible for all the operations in Kenya, which include valuations, commercial and residential management agency, project management, feasibility studies, and general real estate consultancy work. Prior to joining Knight Frank Kenya, Ben was the General Manager of the Tanzanian office for 4 years with a similar role. Ben, I take this opportunity to welcome you to VCB family and address us on this webinar. Thank you very much.
Thank you very much, Manish and Javed. I appreciate that introduction. It's actually taken a little bit of time off my presentation because I won't need to introduce myself. But thank you very much to our friends at Victoria Commercial Bank. Welcome to all you guests this morning who are here to learn about the property market during, during and after COVID, because we'll be looking into the future as well. As Javed said, I've got a panel of guests with me from Knight Frank, so I will be introducing them after I finish my presentation. So I think I will just jump straight in and commence with the presentation so that we can go through and not keep you for too long. I have a timer running, so I have given myself 25 minutes for this. So if there are any of you who would like a copy of this presentation, please do let me know. If you have any questions, as Javed said, please do put them in the chat and we will address them during and after our panel session. So property market performance before and during COVID-19. We're talking about Kenya specifically. So what I'm going to do is I'm going to take you through the Property market, as we see here in our agenda, a mobility index, I'll explain to you what that is. Look at the macro economy, then look at property market activity, specifically offices, retail, residential, industrial, and then have a look at the outlook and the opportunities for investment going forwards. As Manish said, this is a snapshot of Knight Frank across the world. We're a truly global company, but more specifically, we have 618 staff across 21 offices in 9 countries in Africa. And from that network, we're able to service almost every single country on the continent. So we have definitely the strongest coverage on the continent of Africa in terms of international real estate consultancy. These are our service lines. Primarily, we are a property management and agency company where we manage over 7 million square feet of commercial and over 700 residential units. We are also seeing an increase in focus on niche sectors, as you'll see here: healthcare, education, student accommodation, logistics, data centers, and so on and so forth. So we'll be looking at a little bit more about that in future. Now, I want to show you this slide, which I particularly like because it tells a story about COVID. What it is it's 3 lines: retail and recreation, the workplace, and home. Home is red, workplace is green, and retail and recreation is blue. Now, what does it mean? Well, if we start on a baseline of February 2020, before COVID, it tells us how much time people have spent in each of those locations. So the Google Mobility Index shows us that when the pandemic began in March 2020, people instantly started spending a lot more time at home. As you can see, the red went up, and a lot less time in the workplace and a lot less time in retail and recreation. And whilst this is fairly self-explanatory, it does tell us quite a lot about what's been going on. And COVID has impacted all of us. As at the 25th of August, yesterday, the Ministry of Health said we had 232,000 cases, 216,000 recoveries, and sadly over 4,600 people have lost their lives. There's nobody who hasn't been touched and impacted by COVID. But the good news is the vaccination rollout is going well. The world is getting used to how COVID is treating us. And although there are new variants, such as the Delta variant coming out, we are learning to live with this new normal, adapt to it, and overcome. And hence we're seeing economic recovery slowly happening across the world. Hopefully Kenya will soon come off the UK's red list, and we'll start to see much more activity between those 2 countries as well. But that's basically what that chart tells us. And as you can see, people are gradually spending more time in the workplace, more time in retail and recreation, and so starting to come out of their shells, as it were, really from March this year. So moving on, having a quick snapshot at the macroeconomy. This is an interesting graph, to some extent self-explanatory, but my goodness, look at that dip in GDP in 2020. Now that we have two charts here. We have Kenya's GDP versus the sub-Saharan African average, and as you can see, Kenya is almost always above the sub-Saharan African average. And certainly was in 2020, but we saw negative growth as well, just not quite down as low as 2.5%. We see a recovery in 2021, and of course that recovery is scheduled to continue in 2022 and 2023 as well. So this dip results in the need for increased flexibility in existing lease terms, new habits that have changed occupiers' behaviour. The key economic risks included currency depreciation, increasing debt levels, and of course we have, as Manish mentioned, we have elections coming up in 2022. So we're forecasting at Knight Frank at least a 2-year recovery to return to levels in 2019 that we saw in 2019 in the property sector. But however, Kenya, or Nairobi particularly, remains a regional hub for most organisations, and therefore, we are fairly positive about that recovery happening. so the topics that we had during the beginning of the pandemic, the curfew, the social distancing, people working from home, homeschooling, PPE, all of these issues we had to learn the new normal, and we had to adapt and we had to overcome. Interestingly, looking at property transfers, these are transfers as tracked by the Ministry of Lands. So the number of transfers greatly increased in the first half of 2021, and this we explain as a result of a pent-up demand as buyers have taken advantage of the markets as vendors decrease their prices, but also because they've been holding off from those decisions that they were making in terms of making purchases. So, obviously we have the difference between volumes and prices. The volumes are recovering, but prices have definitely reduced during this time period. So, that's good news and bad news. The fact that volumes are increasing is good news. In a sense, the fact that prices have reduced, they've had to in order to get the volumes up, but that also means that there are greater number of investment opportunities for you out there. If we were to specifically look at the office sector, we're looking at a 64% increase in take-up in the first half of 2021 compared to the second half of 2020. So we're seeing a recovery already, substantial. 2020, obviously, we saw a fairly substantial decrease in take-up in 2020 compared to 2019. So that minus 47% in 2020, we're starting to see 64% in 2021. Looking at those office rents, so that's the take-up, that's the amount of space that is being absorbed in the market by people taking space. If we look at the rents themselves, we can see 2015, 2016, a high in almost all sectors. The CBD perhaps peaking a little bit later, but there are reasons for that. But then we've seen a gradual decline since 2016, and then a fairly big drop from 2020 to 2021. But we will start to see those prices come up again. That is our forecast, because we are obviously using up the existing supply, supply, because demand is there. There isn't a lot more supply coming onto the market, and so ultimately price will start to creep back up again. But so supply does still remain a challenge. We've also got new habits such as people working from home. One of the most common questions that I am asked is the office market dead? Now everybody's working from home, surely we don't need offices anymore. And that's not just a question that's being asked here in Kenya, it's being asked all over the world. And yes, certainly we are seeing more people working from home. But the flip side of that is, as we've gone through the pandemic, we've realized that whilst people can do certain tasks at home, it is extremely important for those face-to-face interactions to happen. And businesses such as Twitter, for example, who at one point said, right, from now on, everybody's going to work from home. We don't need office space anymore. They've overturned that decision and gone back to the office. We're starting to see people going back to work. Yes, there will ultimately be a time in the future where offices may need less space, although health and well-being of their staff has become more important, so they will effectively need a little bit more space because of that. But also in Nairobi, because we're a regional hub, we have this constant demand for space, and so that will continue. So I think in the long run, there won't be a huge change here in Nairobi because of that ongoing demand, being a regional hub. And in the short term, we need the extra space for social distancing anyway. So while some people are working from home and freeing up space, that space is giving us the space that we need to provide a safe working distance from our colleagues. So then moving on to retail. Now I love this chart, and this chart I've been talking about really since back in 2018, but you can see in 2017 that huge spike of space coming onto the market in 2017, and that was the year we got Garden City, Two Rivers and the Hub all together. And up until that point, we were in a wonderful position that, a new shopping centre would come into the market every year or so, and we would see new tenants coming into it. All of a sudden, we got 3 shopping centres at once, and the tenants that were there simply couldn't afford or have the capacity to move into 3 new centres at the same time. So for the first time, we started to see an oversupply, and we started to see vacancies in shopping centres. So we started to see that supply dwindle. And of course, 2020, that dip in 2020 isn't really anything to do with the pandemic. It's more to do with the reaction of the oversupply in 2017. So in 2020, what I think you'll see is a dip in 2023, which is in reaction to the situation in 2020. So don't forget, it takes a number of years for these developments to actually come on stream. What happened to retail? Well, I think retail was one of the worst hit sectors, to be honest with you, perhaps after hospitality. And that was really because people were told to stay at home. And so, you know, shopping centres, malls, they are social destinations that rely on people coming out and spending time there. So they were impacted very badly, particularly those that rely on later in the day traffic, such as cinemas, casinos, and so on and so forth. And a number of them were simply closed. So we, managing our shopping centres, we were negotiating concessions with tenants to keep them alive, basically to keep those businesses going during that time. So that was the beginning of the pandemic in March. Those 50% concessions that we offered to those retailers went right the way through till the last quarter in 2020. We started to see a recovery as we went into the festive season. First quarter of this year was good, but of course, at the end of that, we went back into lockdown again, and unfortunately found ourselves in a similar situation. Although not as bad, because people had got used to it. Now, with the easing of the restrictions now, we're starting to see those numbers creep back up again. Residential, the mortgage market, as you can see, unbelievably less than 30,000 mortgages in a country with a population of 48 million people. Really a tiny sector, so very, very little borrowing for the purposes of purchasing housing. We've seen even with that low number, we've seen that number fall. And despite the fact the average mortgage rate is 10.9%, which is the lowest it's ever been. We've seen an increase in investment in affordable housing and student population. So those are 2 sectors that we've seen some growth in, but we still have a housing deficit of circa 2 million units. So affordable housing has remained and will continue to be a key trend in 2021, with, of course, the key player being the government itself. Their agenda being 500,000 housing units through PPP. So we're starting to see those public-private initiatives taking off now. Of course, Kenya has a very young demographic, a young population. And so with the fragmented nature of student housing, I think we're going to see people focusing on that as well. That's a very interesting sector, some development in that sector, but also some repurposing of existing properties as well, where they are in prime locations in good proximity to the learning institutions. Looking at industrial, let's have a quick look at my timer to see how I'm doing for time. Looking at industrial, prime rentals and yields over time. So we can see yields falling and also, but prime rents increasing. Now, I think that's a rather confusing picture. We've got the old style go downs in the top right corner and the new style go downs below. So the old style between 20 and 30 shillings per square foot, the new style 70 to 80 shillings. Wow, that's a huge increase. Yes, it is, but the efficiencies, the economies of scale, the volumetric space that can be used actually means that even though you're paying 2, 3, even 4 times as much rent for your space is that much more efficient that it still makes business sense to operate in that larger and more custom space for logistics and warehousing. Average occupancies between 70 to 80%. Increase in rentals because of more quality stock. So in other words, the rise in rents is not really talking about a rental growth. It's just that across the average, we're seeing more of the high rent stuff coming onto the market, which is pushing that average up. So what's driving industrial logistic trends? A-grade warehousing, infrastructure, PPP, data centers, cold storage, self-storage, all of these different demands on that sector driving it. The upcoming stock around Nairobi, normally in the coffee belt, so that's Tatu City, Talisi, Northlands, all of those areas to the north of Nairobi, really because of the land costs and also the fact that places like Tatu City have got pre-approvals for that kind of space. Who are the institutional investors? Grit, Improvon, Agility, along the major transport corridors. So we're seeing big money coming in from overseas investing in this sector, and that's what's been driving it. There's definitely been a shortfall of good quality light industrial space. We're not talking about heavy here, we're talking about light. This is not manufacturing, this is not steel, this is not cement or anything like that. This is warehousing, really. It's the use of that space rather than the manufacturing process within it. Mix of owner-occupied and investment type stock, probably more owner-occupied than there should be, simply because there hasn't been a choice of people to go in and to say, right, I'll rent that place or I'll rent that place. If they can't find what they want, they tend to build it themselves. Okay, so looking at, in summary, an outlook of those sectors. So we've done here is we've got a chart which shows us what was happening in the sector before the pandemic, the immediate demand, and then our long-term future. So looking at this, the hardest hit sectors were definitely hospitality and also regional shopping centres. So regional shopping centres were suffering anyway before the pandemic, which was obviously made worse during the pandemic, and their future is moderate. So I don't see a huge demand for big retail malls in Nairobi. I think we've probably got enough. However, neighbourhood malls is a slightly different picture. That's the smaller convenience malls filling in those gaps in the catchment areas where we see a positive outlook for those. In other words, we will see more of them being developed in the longer term. The office sector pre-pandemic was moderate, immediate demand moderate, and longer term moderate. But look at serviced offices. This is really interesting. Before the pandemic, they were doing really well. During the pandemic, it was a disaster because there was no long-term commitment from the occupiers. They could simply walk away from their obligations. And so serviced offices emptied. Everybody was working from home. They simply walked away from them. And they were lucky that they didn't actually fall. But of course, for the same reasons, that same flexibility, they are the quickest to recover. They are absolutely flying now. As people return to work, they want that flexibility. They want to be able to walk in and out. And so the serviced offices are doing really well and will continue to do so. They tailor to the current needs of the market exactly. And so that we will see a lot more of as we go into the future. Prime residential, I think it was in oversupply anyway. The slowing down of the market has meant that fewer stock has been developed, and so we will see a moderate recovery over there. Affordable housing has been strong all the way through, as has logistics, strong all the way through. Hospitality, disaster. We all know all the hotels closed. Many of them didn't reopen or have not yet reopened. Of course, we do see a moderate recovery when our tourists start to come back to Kenya. When we start to see the conferencing happening again, then we'll start to see a gradual recovery in that sector. But unfortunately, it will take time, and that sector has been hit harder than any other, even harder than the shopping centres. The next four, student housing, data centres, agriculture and healthcare, are all sectors that have continued to perform all the way through and will continue to do so. These niche sectors, which we're really starting to focus on now here at Knight Frank, we're seeing specific investment in student housing, in data centres, in agriculture and in healthcare. So we've got clients coming in from overseas doing studies on those sectors in our market, looking at, I mean, whether in healthcare it's assisted living or it's hospitals, data centers. Are they bespoke? Are you building them for particular clients, or are you simply building them to the modern spec and then speculatively and then renting them out? Agricultural sectors is getting a lot of traction, particularly from Southern Africa. Of course, we've talked about student housing. That also will be a red hot sector going into the future as well. Just a couple of examples here of the kinds of investments that you could be looking at. These are large scale investments. I mean, $16.5 million is a big ticket price, but it just gives you an example of the kinds of things that are in the market at the moment. Delta Chambers is a building where you can purchase suites, and we're seeing this happening across Nairobi as well. I mean, there was a time 5 years ago where it was very popular, and then it decreased in popularity. Now it's returning to some extent. On the residential side, excuse me, we've got a variety of sort of ideas here, if you like. Karen Land, 32 million an acre. Well, that's cheap. Karen Land has been 55 million for some time. There are some bargains to be had. If you're out there looking, you have cash. You don't have to borrow. You can take advantage of some of the situations that people find themselves in. Unity Homes at Tartu City, from 5 million shillings a unit. Of course, affordable housing, Boma Yangu, under 3 million a unit. That's not really designed for investors, it's designed for owner occupiers. That's the idea, to try and fill in that affordable housing gap. However, the opportunities are there and the opportunities remain. So that is just a snapshot of the market as a whole. I apologize if I went through it quite quickly, but there will be opportunities for you to ask your questions. Don't forget to do so during the chat. This is a list of our most recent research documentation, where we look at various parts of the market. I mean, healthcare is specifically, you'll see there'll be one shortly on data centers and affordable housing as well. There's lots in the pipeline. And of course, we are joined today by our panel who are, well, I'll introduce them shortly, but I will refer back to these research documentations. So that's it from me. Thank you very much for listening. I hope you could hear me okay and you could follow that presentation. What I would like to do now, I'm slightly ahead of time, which is great, is to introduce my panel. And I have today Stephen Macau, who is head of valuations for Kenya. And valuations, of course, is a sector which we are very involved in. We have the largest firm of valuers now in Kenya in terms of volumes of and value of valuations. But also it's a topic that's very, very relevant at the moment when we're looking at the market and how values are moving, how they're affected by the pandemic. Very, very tricky areas for us to move into. So Stephen, please do turn on your video camera. Well done, thank you. I also have Tilda Mwai joining us. Tilda is the senior researcher for Africa. She is based in Dubai, and she is responsible for all of our African research output. So that is pulling together the information that we produce across the continent and consolidating it into fantastic research reports. And then finally, I have Charles Macharia, who is our senior research analyst based here in Kenya. So welcome, Charles, Tilda and Stephen. Charles is responsible for producing all of the data, but also doing feasibility studies as well for our clients, market appraisals, helping our clients make those investment decisions by giving them data, giving them analyses that enable them to pull the trigger on their projects. So welcome to the three of you. Thank you very much for joining me. Right, I think, where shall I start? Okay, I'll start with Stephen. So Stephen, generally, how would you say the pandemic has influenced the ability of valuers to provide credible valuations? Obviously, the market's up and down. There's very few transactions. Some of them are done at huge discounts. Others are done at normal rates. How do you account for all of that? How do you give people a valuation that they can rely on?
Thank you, Ben. for that question, a very timely question indeed. And I need to say that valuers rely heavily on market transactions. And therefore, this pandemic has really thrown the valuer under very unusual circumstances. But nevertheless, of these challenges, we still went ahead and worked around the situation and been able to provide valuations. But if I was to answer your questions, really, how this pandemic has influenced or affected our business as valuers and our ability to deliver our mandate to our clients, one of the biggest challenges as valuers is that we have seen a decline, especially immediately the pandemic struck. We have seen a decline of the volume of transaction in the market. And like I've said, we rely heavily on market evidence. And therefore, what that meant is that we found ourselves in a situation where we have market evidence that is pre the pandemic, but we have a disruptor, and we are finding it tough, saying, look, you had a valuation. We do not have the data. Whatever data we have is pre-pandemic. And that's one of the challenges. Number two is that there was a lot of uncertainty around the rental income that supports or underpins the valuation that we provide. We saw tenants taking advantage of the force majeure in their leases. Others basically going bust, and were not able to pay. So you could have a lease in force, but irrespective of the fact that you have a lease in force, you have a tenant who has gone south and they can't pay, and as a valuer, you face with that circumstances. At the end of the day, you expect to provide.
Yeah. So basically, before the pandemic, you'd simply look at the income, whether it's a tenancy schedule or whatever, and say, okay, well, this income is guaranteed because there's a lease running to this date. Now you're having to say, well, is it guaranteed? Because this tenant may go bust during this time. So you're having to adjust your cap rates to take into account an increase in risk.
Exactly. So you have an uncertainty, and you have to make certain adjustments. And still, the pandemic is unprecedented. So you're also not sure what sort of an adjustment to make. But one of the reasons that we did, one of the things that we did in valuations and advised by the International Valuation Standards and the RICS, is to tell clients that, especially banking clients and everybody else who consumes valuation, including financial institutions and corporates that do valuation for financial reporting, we were telling them that these valuations is being prepared under certain circumstances. And we would include a clause, it's part of our best practice that we call material valuation uncertainty clause. Basically, we are telling the consumer of the valuation report that, look, we have this pandemic and these are circumstances. So you need to attach a less degree of reliance on this valuation, unlike before.
So does that mean the banks are reducing their loan to value then on the basis of the figures? Yeah. Okay, well, we can see there. Yeah, we can see there are various different approaches to how that can be addressed, but obviously it is a challenge that we're going to have to continue facing. If I can move on to Tilda, this is from your perspective of, although you are a Kenyan, and proudly so, I'm sure, you are currently outside Kenya, based in Dubai. So this question is for you. Kenya has continued to be among the top investment destinations in Africa in spite of the pandemic. So we've continued to see growing investor interest, especially from the Middle East, into mainstream and alternative real estate sectors. So those alternatives we've discussed already. What do you think are the reasons for this?
Thank you, Ben, and good morning to everybody. Yes, I am Kenyan and very proudly so. But back to your question, I think on one hand, what we were saying even before the pandemic is that investors were actually on a very aggressive hunt for yields globally. And when you look at Kenya, it has continued to rank as a top investment destination across Africa. And the reason for that is that it has actually continued to tick the right boxes by consistently, for example, improving on its ease of doing business, infrastructure development, and as such, we were seeing institutional capital flowing, especially from the Middle East, with a bias on sectors such as agriculture and retail. With the pandemic, what we have seen is that innovation has actually taken center stage, And it has been one of the themes that is leading recovery at the moment, or that we expect to lead recovery. And in a recent ranking that we did on African cities as Knight Frank, we did based on innovation factors such as innovation activity, level of innovation infrastructure and funding. We actually saw that Nairobi continues to rank as the most innovative city in Africa. Now that has a trickle-down effect to real estate. And because of innovation, then there's the need by employers, for example, to continue attracting a diverse pool of talent. And this is important to most employers. And so the type of space that they actually occupy is then becoming very important to them, and is leading to a trend that we are seeing being called as the flight to quality in occupying grade A offices. The other thing that we are seeing is that there's a growing interest in sectors such as data centers, because obviously with innovation and the tech needs and all the other factors, then we are seeing a lot of interest in the data centers sector. And we've seen operators such as iAccelerate coming into Nairobi and committing to develop the data center space. So it's definitely going to continue being a leading investor destination for quite some time now.
Excellent. That's very good news. I'm glad to hear that. Thank you. So Charles, one for you. The first half of 2021 witnessed a significant increase in the level of land transfers. Other than returns, what else are investors looking at when investing in real estate?
Thank you, Ben. Good morning, everyone. Yeah, so basically investors are increasingly applying various non-financial parameters as part of their analysis to various investment opportunities. And specifically, we are looking at ESG factors, ESG standing for environmental, social, and governance factors that are part of the sustainable investment agenda that is aimed at creating value by building investor goodwill. Now, when it comes to environment, we are looking at factors such as climate change, air and water pollution, energy efficiency, waste management, and consequently, we are seeing developers implementing this element of environmental conservation in their design, either through getting green certifications or through their operations. You find that in some countries, such types of investments have favorable tax implications, but overall they have the effect of reducing operational costs and thereby increasing the value or the value of the investment.
I think that's absolutely right. I think also, Charles, the other thing is that, you know, as we get more and more international tenants coming into our market, they're going to be making demands for these kinds of buildings as well, aren't they? So those buildings that don't qualify for those ESG standards are going to start to lose out. So I think the advice to our clients would be make sure that you do understand where the market is going, what the occupier wants. Otherwise, you're going to find yourself left behind by smarter developers with more compliant buildings.
Yeah, more compliant buildings and more operational efficient. The other factor is the social factor. So when going into an investment, an investor is considering factors such as customer satisfaction, data protection and privacy, gender and diversity, employee engagement, community relations, and for development, labor standards. So they're just not buying a development off the shelf. They're looking at what's exactly behind the curtain. When it comes to governance standards, you find they're looking at bribery and corruption, political contributions, board composition, just a greater investigation of what exactly the investment is behind the scenes.
Yeah.
So
yeah.
And yeah, so and you find that various investments are continuously making such types of disclosures.
Sure,
so,
sure.
Yeah.
So more accountability, more transparency. Exactly. People aren't simply looking at a building as somewhere to house their business. They want to know what its environmental credentials are, how efficient it will be, and whether by occupying it they will be contributing to Kenya's corruption or fighting against it. So that's fascinating. Thank you, Charles. Just before I move away from you, I wanted to just ask you one more question. We had a slide about mortgage rates. Very interestingly, you know, in spite of mortgages being the lowest that they've ever been in the recent past, you know, we saw a decline in mortgages in 2020. Why, when the rates are falling, why do you think the numbers of mortgages are falling? And when finance is becoming more affordable, and do you foresee that trend continuing?
Yeah, a recent survey that was conducted found that obviously the pandemic contributed greatly to the decline in the mortgage numbers. You find that financial institutions, because of the uncertainty, were just not in a position to lend aggressively as they were previously. Though we are seeing in the first half of 2021, this trend has reversed quite a bit in terms of there is increased lending. So we expect that the mortgage numbers to climb quite a bit. Another key reason that was given were the historical high land and construction costs. However, given the market conditions, we are finding that property prices are falling quite considerably. From a Knight Frank perspective, we are seeing a decline of over 20% of the asking prices in property values. So we would expect that to transfer into less capital costs and increase mortgage rates because of the increased affordability. From a market regulation perspective, we are also seeing the introduction of or the operationalization of the Kenya Mortgage Refinance Company. That is a mortgage company that is specifically catered to cater for the affordable housing sector through a provision of capital to the primary mortgage lenders. Thereby, it is expected that through this, the interest rates are supposed to come down and therefore get greater uptake. So we expect this trend to reverse in the near future.
Okay, great, thank you. So Tilda, one quick one for you. We've talked about niche sectors. We've seen, as I said in my presentation, a lot of interest in healthcare specifically. What do you think makes this investment so attractive to investors, this sector?
I think, as Charles has said, there's a lot of non-financial factors that come into play. And for healthcare, there are a lot of factors really, but probably I can talk about 3 of them. So the first one is demographics, and that has been an important driver to healthcare. To paint the picture and with a focus on Nairobi, we see Nairobi's population is expected to grow from the current 4.4 million to around 6 million in 2030. And just that means that each year we expect that at least 200,000 people will move into Nairobi. Now, when we look at the bed to population density of Kenya, it currently ranks at 1.4, which is well below the world standard of 2.9 per 1,000 people. And so with increasing population, that gap is expected to widen if there's no increased investment in healthcare. And so that creates a clear opportunity. The other thing is lifestyle diseases, or what is being called non-communicable diseases. And what we are seeing is that it is on the rise. And actually, recently, I think the Ministry of Health for Kenya, in a recent report, indicated that 39% of the deaths in the country are because of non-communicable diseases. And these have also accounted for an increase in 27%, have also grown from 27% to 39% in 2020, so 27% from 2014. And this is reducing household income, obviously. And so Kenya needs around $3.5 billion to meet this need and to cater for these non-communicable diseases. The ministry indicated that they only have 6% of the funds that they need at the moment.
So the rest has got to come from the private sector.
Yeah, the rest needs to come from the private sector. And so we're seeing them embracing notions of public-private partnerships more willingly now compared to what was happening pre-pandemic. And then obviously with the pandemic and the fact that people couldn't travel, so medical tourism and outbound medical tourism to India and all that is no longer happening. But the interesting thing that has happened, Ben, is that the pandemic has actually placed Kenya as the lead medical tourism destination in Africa. So now African countries are looking at coming to Kenya and to Nairobi for
So that's a double opportunity then, really, for investors, isn't it? It's to cater for the internal demand, but also to cater for the fact that Kenya is becoming a healthcare destination in its own right.
Yeah, so I think it's the fact that there's clear need for this sector, and that the environment is actually supporting, or the discussions that are being held are actually supporting private sector investment into this sector.
Yeah, so that's brilliant. That's fascinating. So that's an example of one of the niche sectors in the property market that we were talking about. That's healthcare. We also spoke about student accommodation. We spoke about data centers, and of course, slightly more mainstream warehousing and logistics, which segues nicely into a question that I have from the chat, which is, how is e-commerce online shopping, i.e. Amazon, Jumia, etc., expected to shape the retail sector occupancy in the future? Well, I think, speaking personally, and I'll hand over to Charles, I think, after this, because it's a question specifically relating to Kenya, but speaking from an anecdotal perspective, we've seen a huge level of disruption to retail from e-commerce and online shopping elsewhere in the world. The States and the United Kingdom, the rest of Europe, for example, huge amounts of vacancy, shopping centres being traded at incredible yields, lots of rent reductions going on across these markets as the high street and also the mainstream shopping centres are suffering because of Amazon and so on and so forth. Now, that is your ability to choose an item online at 5 p.m. and have it on your doorstep by 10 a.m. the next day. And that's had a massive impact on retail. Now, we don't have that last mile delivery here in Kenya or in much of Africa yet. So basically what that means is we don't have the infrastructure to allow e-commerce to completely take over from people going to a shop and buying. It does happen. We've got the bodabodas delivering and so on and so forth, but the infrastructure is not nearly as complicated, complex, or as developed as it is elsewhere in the world. In addition, generally there's less to do here in terms of lifestyle activities, and so I think malls here are still destinations, lifestyle destinations, and so they will still remain popular from that perspective. So that's places for people to go, to eat, to be entertained, to interact with each other, and so on and so forth. So I think that the malls are not dead in Africa. They've got a long way to run, but there will definitely be an increasing level of disruption as that last mile becomes more and more developed here on the continent. Charles, do you want to add anything to that?
Yeah, yes. It was.
You're not allowed to disagree, by the way. You're only allowed to add to it.
Yeah, definitely. All protocols observed. Yeah, so definitely there's been an increased emphasis on e-commerce, not only in Kenya, but in Africa. It's estimated that the e-commerce market grew 40% alone in 2020, implying there was a great increase in online activity and purchases. With regard to a question I saw in the chat, with regard to retail occupancies, mall occupancies, previously our 2019 report that we released way back before the pandemic showed that mall occupancies were at 77%. We expect this number to have gone down during the pandemic to the 70 to 75% levels, though we are seeing more of landlord-tenant relationships being strengthened in terms of working together towards a more sustainable future. So the occupancies, though drastic, we will see more cooperation and more new ways of the landlord-tenant relationships so as to maximize on the occupancies. The e-commerce sector, yes, continues to be a disruptor, but what is a loss on one sector is a win for another sector, such that you find that the logistics sector is a beneficiary of the increased e-commerce in terms of more industrial and logistics development, as we've seen the increased investor appetite for various logistics types of development. So a loss in one sector is a win for the other.
Yeah, thank you for that. Right, I have another question here from the chat. Property valuations, do you think values have dropped and if the pandemic has had an effect on valuations? So I guess this is talking about, you know, has there been a negative impact on values as a result of the pandemic, and will that negative impact carry on into the future? Is it a permanent change or is it a temporary blip whilst we're in the situation? I think, Stephen, that one's for you.
Thank you, Ben. The answer is certainly yes, that the pandemic has affected property values. However, the magnitude is not uniform across sectors and locations. Given the impact the pandemic has had on retail and hospitality, I would say hotels and shopping malls have borne the biggest impact of value cuts as far as the pandemic is concerned. To a lesser extent, office, but we are seeing a quick recovery because rents are rebasing and the new yield curves are being reestablished to the new level of sanity, and therefore the cut is not as big as hospitality and retail. Residential has more or less remained flat. We have seen increased activity and therefore closely, recovering towards the pre-pandemic levels. We are not yet there, but we are headed there. So the impact is negative, some flat, some unchanged, but I would say we are heading towards recovery. I'm not sure whether we'll get to the pre-pandemic levels. Yeah, but not looking bad.
Okay, great, thank you. Another question from the chat, and I'm just going to keep answering these questions, Javed, unless you jump in and tell me that we're out of time, but there are more questions than we can possibly answer here. So whichever ones we can't answer here, we will definitely do so by email afterwards. But also, before we go, you have got a great team here in front of you. If there are any other questions you want to answer, or if there is a copy of this presentation that you want, or any of the research documentation that we've discussed, please do get in touch with us or get in touch with our good friends at Victoria Commercial Bank, who will be able to put you through to us, and we will be able to help you there. Okay, next question is, Knight Frank seems to indicate Grade A offices will be in demand with low upcoming supply. Kindly enlighten us as to what you consider existing Grade A buildings. There are only a few, and any new ones coming into the pipeline. Well, actually, this is a fascinating subject because obviously each market has its own definition of what a Grade A office is. And it just so happens that our very own Tilda Moy is doing an exercise at the moment, looking at the grading of offices across the continent. So I think that this is definitely one for you, Tilda, to have a quick look at.
Thanks, Ben, for that. I think when it comes to Grade A offices and what we mean by prime buildings, it's really buildings that put occupier well-being at the very forefront. So it goes into the technical features such as how a building is designed and how the different, whether it has a lift, proper lift experience and the type of security, to the softer features such as what's the sort of air ventilation in that building and all that. So there are a lot of factors that are looked at in terms of talking about Grade A buildings. What we've seen is actually that Nairobi, interestingly enough, is a lead in terms of the level of Grade A building supply that is in the city. So it continues to rank quite highly in terms of that. And although, of course, if compared to the other types of buildings, whether it's Grade B and C, then grade A is really in short supply. But what we're seeing is that with all these factors and what Charles talked about with ESG, then what we are likely to see moving on is that there's something that will be called brown discounts. So with green buildings, then you get a rent premium and green premiums, because then there's that added advantage of having a green building and occupiers then being able to occupy. But if those buildings are not in the market, then what we're likely to see is that landlords will offer brown discounts, because then they are not meeting the level of efficiency that will be required by occupiers. And so that really will be a greater motivator to develop grade A buildings. I think Charles can talk about specific examples of grade A buildings.
Well, I mean, I can do that. Obviously, One Africa, I think, is probably the benchmark that we would see set here in Nairobi. I think, you know, interestingly, though, we do have a client at the moment who is looking for specific requirements. Specifically disabled access, disabled facilities, and he hasn't found any buildings within Nairobi that comply to what their international standard would be for disabled facilities. So you know, one has to be a little bit careful about simply spending more money on chrome and glass and actually putting stuff in that people want and would qualify as grade A. But we will be producing some statistics about that, and I think that will certainly help investors make decisions. Sorry to cut you in there, Charles. I do have a quick question for you here, and I think this will probably have to be our last question. After that, I would say that please do contact us at Knight Frank. We've talked about some great niche sectors to look at. I think that's where most of the activity, most of the interest is going to come from. But before we sign off, a quick question here. We've focused a lot on Nairobi, and we're always guilty of doing that because, of course, Nairobi is the regional capital, and so it's bigger than the other capital cities in the region, but it's also disproportionately larger than the secondary cities and towns in Kenya. But the question is, how are the upcountry centres like Mombasa and Eldoret doing in the real estate space? So Charles, do you want to have a quick go at that?
Yeah, thank you for that. Yes, so basically the trend with Nairobi is the trend across Mombasa and the other cities out there. Obviously, each has its own unique challenges. For example, Mombasa, with the various infrastructure projects that are coming in there, and the establishment of the SGR and the expansion of the new port, and fundamentally its economic activity, which is tourism, has been hit hard by the pandemic. So I think they're at more of a disadvantage when it comes to how the outlook is at the coast. Nairobi is very diverse in terms of economic activity, so it's less hit in terms of the effects on the pandemic. So until we get some form of normality, Mombasa, cities, outskirts cities that rely on tourism like Mombasa, will be greatly affected. For the other counties, there's still a lot of infrastructure development going out there. This is mainly by the central government, and this is mainly to spur economic development. So as long as those continue going on, we are likely to see some form of recovery. But again, it's on a case-by-case basis and on a city-by-city basis.
Okay, thank you very much, Charles. So I think that brings us to a close of this session. I would like to thank my panelists for answering those questions so lucidly. Please don't forget they are here, they are available, and they will be able to answer any other questions that you have. And particularly if you want more detailed studies and so on and so forth. And finally, just leaves me to thank very much our hosts at Victoria Commercial Bank for giving us this opportunity to talk to their clients, as well as some of our own who I believe have joined as well. Thank you very much for that opportunity. I hope you've enjoyed that session. I hope you found it useful. Please don't hesitate to get in touch if you need us to do anything else for you. Thank you very much. Back to you, Javed.
Thank you. Thank you so much, Ben, Charles, Stefan, and Tilda, for your valuable insights into the property market. Indeed, this has been a very informative and an interactive discussion. And should there be any additional questions from our clients, we'll try and get them answered by the Knight Frank team. We will also be able to share a recording of this webinar to anyone who needs it. But as we come to the end of the webinar, I would like to invite Victoria Commercial Bank's Head of the Legal Department, Ruth Mwasia, to offer the concluding remarks. Thank you.
Sorry, Ruth, you're on mute.
Yeah, thank you. Good morning, everyone. I just want to thank you for this wonderful opportunity for attending this forum. I want to thank our distinguished team from Knight Frank. Thank you for a good webinar. Thank you for trying as much as you can to answer the questions that have come within such a short time. And thank you very much for even the informative webinar that you've given us. We now have more information on what's happening in the property world. I must quickly comment that we are no longer the same as we were before we joined this webinar. Now we know what to look out for. We know where the opportunities are. We know what to do to add value to our properties, especially with regard to ESG. Thank you very much for pointing that out. I also want to thank you, our esteemed clients, for making time to be with us today. Being a working day, we don't take that for granted. And our prayer is that this webinar has been of great help to you. And going forward, it will add value to your investments, to your plan with regard to property and all that. So we want to say thank you. I also want to thank the organizing team, both from Knight Frank and Victoria Commercial Bank, for a job well done. Thank you for taking your time to make this a success, and also just to ensure that we all partake of this knowledge session. So thank you, everybody. Thank you, Knight Frank, and thank you for being a great partner to the bank. And we look forward to more of these sessions where we can get to hear from you and learn what's been happening in the market. We also want to thank our board for allowing Victoria Bank to continually engage with such partners and even making time to be with us today. Thank you, everybody, and have a great day. In case you have any questions, as they've said, you can always drop an email and we'll see to it that all your concerns are addressed. Thank you and have a great day.
Thanks very much. Thank you, everybody. Bye-bye.
Okay.